Hello, everyone. This is Jason from CPA Academy. I am so glad you are all joining us for a free CPE webinar on a very current topic, preparing for the impact of the Wayfair decision, what retailers need to know. And you are all in for a real treat. We have Justin and Bobby from DMA who are going to be guiding you through this presentation over the next hour, and they are going to share their knowledge with you on this very important topic for, I'm sure, all of our attendees here on the line. Before we get going, I just want to do a couple of quick technical checks and some housekeeping, make sure everything's working as it needs to. So if you all don't mind going over to the questions panel of the GoToWebinar control panel, let me know that you can hear me, let me know that you can see the slides that are up right now. And while you're in there, let me know where you're listening in from, just so I can check that everything's working with GoToWebinar. I see people checking in from New Jersey, North Carolina, Minnesota, Texas, Florida. Welcome, everybody. So glad you're all spending part of your day with us here at CPA Academy. If anybody's having any trouble seeing or hearing throughout the webinar, please let me know in this questions panel. We'll do the best we can to get the troubleshooting done quickly and put your focus back where it needs to be. Although please keep in mind there are a lot of you and there is only one of me, so I'm going to do the best I can to get you all fixed up as quickly as I can. A little bit of housekeeping regarding CPE for today's course. Today's course qualifies for 1 CPE credit. And in order to earn that CPE credit, you have to be logged in for at least 50 minutes, that's 50 minutes out of the hour, and answer the polling questions. Polls will pop up on your screen periodically. You'll have about a minute or so to answer the poll by clicking on the response that best corresponds to your answer, and then clicking submit. We're going to use the polls along with your time logged in to issue CPE credit, which will be done by the end of the day today. And that credit will be available in your CPA Academy account, along with an archived recording of today's webinar and a copy of the handouts. And I see a couple of people in the questions panel are asking where the handouts are. They are over in the handout section of the GoToWebinar control panel. Should be right underneath where the questions panel is that you're all using to answer where you're listening in from and telling me that you can hear me. So go ahead over to the handout section. You can download a copy to follow along with at home or to refer back to in the future. And of course, we want to thank Avalara for sponsoring today's webinar. Avalara is responsible for so many great sessions here on CPA Academy, including this one and so many others. We're grateful to have them sponsor this and so many great sessions and bring some really fantastic content to all of you here on CPA Academy. So now I would like to turn today's presentation over to Justin from DMA to get it started. So Justin, the floor is yours.
Well, thank you very much, Jason. And as Jason had mentioned, thank you everyone for joining us today. Both myself and Bobby Barnes will go through Wayfair. Our plan is to provide some information on the current status of Wayfair, the state regulations, and then the decisions you'll need to make as an organization, both from a tax and a technical standpoint. Much like any presentation, we do have the disclaimer in here, which just gives the general guidelines of the information you'll find here within. From an agenda standpoint, following the introductions, Bobby will lead us through the Wayfair court rulings as well as each state's reaction. Very timely as the reactions are modified on a weekly, if not daily basis right now. After that, I will go through the tax and technology considerations. Jason will have those 4 polling questions in there as indicated, and then a Q&A to the extent we can get to any of them added into this section. So as means of introduction, I'm Vice President of our Tax Technology Operations here at DMA. I've been in this position for a little over 10 years now, located in Cleveland, Ohio. A little bit about DMA, we're a state and local taxation firm focused on sales and use, property tax, state income, unclaimed property, and tax technology. Bobby, did you want to do a brief introduction as well?
Yes, as Justin said, Bobby Barnes, Vice President of the Compliance Operations for DMA in our business license, property tax, and sales tax compliance, all 3 areas out of our Indianapolis, Indiana location.
Thank you, Bobby. And if you could continue right into the court ruling.
All right, so we're going to start with a little bit of background on the ruling and where it came from. We won't go into a ton of detail on it, but we will hit some high points on here to kind of, based on, what the decision was, how it came about, that sort of thing. So we won't delve too much into that. So basically, in June 21st of this year, the court came out with their ruling in a 5-4 decision for South Dakota Wayfair ruling, and basically overturned the physical presence rule as unsound and incorrect. This has been working through the legislatures for the years, and then finally into the court systems, all the way through several different courts within South Dakota. And so finally it wound up at the Supreme Court and did get overturned 5-4. And basically in the past you had a physical presence requirement on the in order to require sales tax to be collected and remitted by someone within the state, and didn't really apply to people over the internet or catalog sales, that sort of thing. So the reason that they allowed this to go through was because of the way that South Dakota had worded their statute. And that way it offered protection to limited sellers, because that was the big, barrier in the past. So they had very few exceptions. Excuse me. So excuse me. So basically, the Supreme Court ruled that South Dakota did offer enough protections to be able to overturn this. And so as a result, companies that currently sell remotely with no physical presence in the jurisdictions, they are now required, if they meet the requirements that, according to South Dakota, has established, and many states have now followed along those lines to be able to implement that and have the protection of the Supreme Court ruling. And so South Dakota's law requires that if you have more than $100,000 of sales in South Dakota or 200 more transactions, then there was a reason to have a filing presence in that state based on economic thresholds. And so now you have to go ahead and prepare those sales tax returns, file those, collect, and those sort of things. We'll get into more of the details of which states have also followed that route, what the dates are, and that sort of thing. And then on September the 12th of this year, the governor signed legislation with an effective date for South Dakota that started November the 1st of 2018, is when you have to begin collecting in South Dakota. But we'll go through several states that have had an earlier due date and enforcement date than what South Dakota has. So we'll go ahead and talk about that here shortly as well. We can go ahead and go to the next slide.
Before switching slides, Bobby, with South Dakota, I was just going to add that is an or statement. It's 200 transactions or $100,000. I know some organizations have asked us that question in the past. That is 100,000 or 200 transactions.
Correct. And we will have a little bit more towards in the middle of the slide deck. We'll have some states have varied from that a little bit. Most of the states have tried to mimic as much as South Dakota as they could. That way they won't have the opportunities to be taken to court over, going outside the boundaries that the court has established. So we'll talk about some of those where they have different thresholds for either transactions or revenue, and then some other areas as well. One of the unique things we had about the decision was that it was a split decision, of course, 5-4, but it also didn't align with party lines. So we had Kennedy, Thomas, Alito, Ginsburg, and Gorsuch were the ones in the majority, and then Breyer, Roberts, Sotomayor, and Kagan were the ones that dissented. So it was a little bit different than, it's not 5, from one party and 4 from the other. It's kind of a little bit of mixture there. So that's kind of a little bit unique. And this was kind of brought about because Justice Kennedy prompted states to prepare to actually bring this to the Supreme Court. A few years ago, he had said that he thought it was Wayfair, the Quill ruling was probably outdated and it should be brought before the court. So he kind of, made that in one of his opinions known, and so South Dakota was the one that got it to the Supreme Court first, so he basically had encouraged that. The prior Quill ruling was in effect. Only 2% of Americans had internet access when that ruling was passed. So, it wasn't foreseen that the e-commerce there wasn't no e-commerce basically back then. It was mostly catalog sales. So they wanted to make sure that, that had the internet access was a big impact on that, and every year states were complaining more and more that people were buying things without having to pay sales tax or use tax. And so it was getting a bigger and bigger financial burden to the states that they weren't collecting as much money as they would be otherwise. And now it accounts for nearly 9% of retail sales, and it just grows every year. Most everyone, shops online, gets things online. So, it's just growing year after year. And there's been several studies, and some have been as low as $8 billion annually, and some are as high as in the mid-30s. Mid-$30 billion range to see if, taxes were collected on those sales. That's what it would be. And so you have the unfair competitive advantage of internet versus brick and mortar stores in your state. So it was just growing more and more every year. So that prompted everyone to do that. So, and then there has always been the law of saying that if you buy something and do not pay sales tax when you purchase it, then you should file a use tax or a sales tax return. And that has been very minimal collection on that part. Hardly anybody does that. And so the states say we have this in place, but no one's doing that. So over the years, states have been presenting new methods to try to attempt to get around the physical presence law that the ruling that was in place with Quill. And so they're trying to tax remote sellers in different ways. So they kind of started back in the late 90s, the Streamlined Sales Tax Project, to kind of get more states to come together. They've done some cookie nexus items, click-through affiliate nexus, marketplace nexus. Reporting requirements has been the most recent one that they've had some success on. So that's kind of where you have to report what you've sold to someone and did not charge sales tax. There are several states, and more states were doing that, you know, as the last couple of years went by. So it was getting more burdensome on people to do that, which is the whole intent of what they were doing, is trying to get you to either make it so onerous on you to report the sales that you had. That way they would prompt you into collecting the tax and just not having to do that at all. And then finally, now we have Economic Nexus, which is, you know, what we're dealing with now from the result of the Wayfair case. And some of the reasons, the justifications that the court included were South Dakota made it very simplistic for the small taxpayers. You know, the large taxpayers, people didn't have a problem. So if you had, you know, 10 million in sales in a year, they felt that you would be able to meet that obligation, no problem. But the smaller you were, that you may not have a tax department, you may not have, some calculation engines to be able to do all these calculations for different states. So they kind of wanted to make sure that, you know, you had to be a decent sized company in order to do that. So they considered a high threshold of $100,000 of gross revenue or 200 transactions in a year. So that was one of the big points with the court, saying you're not making it burdensome on the small taxpayer that, you know, may have just 2 or 3 sales of $5,000 into a state. So you didn't have to, you know, worry about setting up a whole tax collection system to do that. Another item that was big on their list was it's prospective only, no retroactive taxes. So they mentioned that several times throughout the decision. So it's, you know, on your start date, forward only, it didn't go backwards. And then the next one was the adoption of the Streamlined Sales Use Tax Agreement. And the reason for that is there's standardized taxes and requirements in there, state level administration. You're immune from audit liability with the U.S. if you utilize a CSP provider, and there's uniform definitions of products and services. So they kind of mentioned all these things in the ruling, saying these are the reasons that we're overruling Quill, is because they've made it this simplistic. And so if you follow these similar guidelines, then you should be okay. So we'll talk about some states that are kind of going to be challenging a little bit of that, kind of not adopting every single one of these, and, you know, what the ramifications are to the taxpayer and whether it'll be, you know, pushed through or not. And as I mentioned earlier, South Dakota begins enforcement November the 1st of 2018. That just passed a month or so ago with the official date that they would be doing that, because it got remanded from the Supreme Court back to the Supreme Court of South Dakota, and then had to go back to the lower courts and then get reassigned. So by the time all that got done, now it's November the 1st is the due date for South Dakota. The other thing is all other tax requirements in place are still there. So if all the physical presence tests still apply. So if you have physical presence, you still have to register under that type of system, and you don't go with just the remote sales. You have to go with actually your physical presence. And if you had reporting requirements in the past and don't apply under the new rules, then you still have to report and not remit if you fall under those thresholds as well. I just wanted to make sure we covered that piece of it, to make sure that you knew that, you know, you can't just unregister in one and just switch over to the other one. And then states that are not in the Streamline Agreement currently are attempting to either make their rulings, legislation, those sort of things. They're trying to make sure they're as close to the things in the Streamline Agreement as they can get, but they can't all get there in every single way. But they are trying really hard to make sure that everything that the court addressed as the reasons, that they go ahead and get that done. some things to consider. Now, we don't think any of these will happen, but I did want to mention some of the things that have been presented in Congress. Now, Congress can pass a law to clarify whatever they would like, as long as it's signed by both houses and the president. Then it would override what the ruling was in some of the states, what the states have already done. We do not think that's going to happen, but I thought I would at least mention some of those. The first one is called Stop Taxing Our Potential. That would basically reset physical presence. That one has, I would say, almost practically 0% chance of passing at any point in time. The other problem with the other two is they were recently introduced here in the past month, but I think because there's already so many states on board on this that it's not really likely to happen on these either. But I did want to mention what some people in Congress were thinking when they put these together. They wanted to make it no retroactive taxes, which is already stated, and make it effective for everybody on 1/1. Have one state authority, a uniform tax rate, and then no local taxes or reporting requirements to those local taxing jurisdictions. The Online Sales Simplicity and Small Business Relief Act, it basically it's very similar to the other one. Start date of 1/1/19, no tax prior to the decision. One of the different things is you have to be in a state for 15 days in order to meet physical presence. And then the small business remote seller limit is $10 million in sales across the whole United States. It's not limited to an individual state. And then the other one, the last point was it would direct the states to establish a compact for collection of sales tax, and they would override any small business limits that the Congress had put together in the new bill. So again, we don't think any of these occur, but I did want to mention that those are out there, and there are some people that would like to have these things go through. There were a couple of states that were trying to pass some laws as well the first month or so, saying that they wanted to not allow out-of-state vendors to force them to collect sales tax if they didn't have one. That kind of went away as well. The other two things, or the other one thing is, during the hearing for the Supreme Court, they did say that 38 states did commit to not go retroactively back on taxes and try to collect those, and most states are conforming to that. So that's good to hear that most of them are sticking to that. And then we talked about looking at the possible legislation. I already discussed that part of it.
So before going into the, I was just going to add, before going into the state reactions, Jason, this may be an appropriate time for the first polling question.
That sounds good to me. I'm going to go ahead and launch the first poll question. Should be live on everybody's screen right now, and we're going to leave the poll question open for long enough for a majority of you to get your responses in, receive credit for today's session. And I'd also like to remind everyone that if you have any questions for either of our presenters, for either Bobby or Justin, please ask them in the same questions panel that we used earlier on to check sound and check visuals. As Justin said earlier, we might have some time for an audience question or two on air later in the webinar as we get towards wrapping up, and maybe even might have time for a question or two during these poll breaks. So I'm going to go ahead and leave this poll open for about another 5 or 10 more seconds while you all get your responses in. Again, this is poll question number 1 out of 4. And I'm going to go ahead and close this poll down in 3, 2, and 1. And the slide should be back up for everybody. All right, back to you guys.
Perfect. Yep. Thank you very much, Jason. Now we'll go into the state reactions, and we do have another polling question on this here in a slide or so. But this is just how all of the states have reacted and what we're seeing come through since the South Dakota ruling came in. Oops.
So the first slide here, we'll go over the states that already, since we're October 3rd is today, so we'll go into saying, okay, these are the states that you should already have something in place or be planning to do it, or at least evaluate it. And we'll kind of give a little background on some of the states that are a little bit different than the other ones. So July 1st came, and there was a few states, which 3 actually followed through with it, but there was another state or 2 that kind of pushed their date out after that. Hawaii is the one that has retroactive aspects currently, and it's not that they're going back prior to the decision or prior to July 1st. It's when they ask you to analyze to see if you've met the threshold for filing or not and collecting. Whenever you hit that point, whether it be, if it's July 1st and you start collecting July 1st and you have no problem, but if you were to hit the limit, say in October, November, or December, then you are responsible for going back to that date in order to do that, and then on the calendar year thereafter. So it does have a little bit of retroactive aspect currently. There's been some things submitted to them by different taxpayer advocates saying that they think that should be changed. They may or may not change that, but that is something you need to be aware of, that once you hit that threshold, then they do want you to go back. $100,000 is the threshold, so they're going to want you to go back and collect it on the first $100,000 that you had, and not just from $100,000 and forward. So just be aware of that when you deal with Hawaii. Maine and Vermont were the other two states that also started July 1st. So those are the first ones you have to look at. We'll talk a little bit more, and Justin will go into it in a little bit more detail of how you need to analyze these, how often you need to analyze, that sort of thing of what you need to be looking for, how to go about registering, that sort of thing will be covered a little bit later. The other thing is we've talked about some states have a notice and reporting that were effective in prior years, and so if you are now required to remit, you still have to go back and basically whatever day you're responsible for remitting, and you start doing that, whether it be October of this year or February of the next year, you still have the notice and reporting requirements that were in effect that you may have already fallen under. You do have to continue to do that. So just make sure when you start filing that you do that last true up from when you either first started being required to do that, or if you did it last year, then January 1st of this year all the way through when you started having to do that. So Rhode Island is one of those states that has that requirement. So that's a key thing. Obviously, if you're dealing with a low volume of sales, it's not that material of amount, but still something you need to consider and make sure that you do. So the next effective date we had was Mississippi for September the 1st. And then I don't know if everyone's heard, but recently on the news, I've heard it in 7 or 8 different news channels, in the newspaper, people talking about it. So a lot of states starting becoming effective 10/1. So we had these 11 states either that started a requirement or started having requirements for reporting. We'll talk about that a little bit here in a second. So when looking at this list, a couple that stand out is Alabama. Alabama, they have a lot of home rule jurisdictions that they have in the state where you have to file locally. For when they set up their parameters, they set it up to where if you meet the remote sellers requirement, then you don't have to file in all those local jurisdictions. They offer you to be able to file one return to the state at an 8% flat rate. So when you do register, Justin will talk about this a little bit more, just make sure you're registering in the right method to best benefit yourself. So that's one thing that they did to make sure that they kind of complied with what the Supreme Court ruling had stated of the reasons why they were doing it, because if they didn't do that, then they would not meet the simplicity argument that was in there. Some of the other things, Maryland is in here for October 1st, but they don't really have a collecting requirement. They have basically a record-keeping requirement. So you can look at that in more detail on their website, but it basically says you need to start tracking as of October the 1st and then looking to see when you meet that threshold. And then the other thing is they're using $100,000 and it's for starting October the 1st. So if you already had 500,000 or 600,000 in sales before October the 1st, you're still not required to do it until you hit 100,000 after October 1st of 18. So you may not have to register in 2018 because you only have 3 months of sales, but in 2019, if you have that exceeds 100,000, which is much easier in a full year, then you would be required to actually file, register, and start collecting and remitting the tax at that point. Another one that's interesting on the list is Indiana. They had a lawsuit that was holding theirs in place to where it could not be enacted. So that did get settled a month or so ago. And so they got cleared to be able to have an October 1st effective date. So they also have that effective date started here a couple of days ago. So, and then another one is Washington. They do have reporting requirements as well. That we mentioned, kind of like Rhode Island notice and reporting, so they have that down to $10,000. So if you're the $10,000 to $100,000 range, you still may have some reporting requirements in Washington and a couple other states that have low-level reporting requirements that's still in effect. So just make sure when you're doing your analysis that you're looking at those smaller reporting thresholds to make sure you're in full compliance with everything, and not only the states that require you to collect and remit.
And Jason, before we go into the state effects that are coming up, can you please release the second polling question as well?
Sounds good to me. Poll question number 2 should be live on everybody's screen right now. You all voted pretty quickly on the left. Oh, I'm sorry, please.
Sorry, Jason, I was just going to add, while you guys are filling out this question, I would comment that when you look at the appendix we have in the handout, we do have some resources listed in there that can be leveraged to identify any of these changes in state rulings and interpretation as they're changing quite rapidly.
We're going to leave this poll question open for about another 10 seconds or so everybody can get their responses in. If you haven't voted on the poll question yet, now is the time to do so. All right, I'm going to go ahead and close this poll question down in 3, 2, and 1. And slides are back up. Justin, back to you.
Thanks, Jason. I'll hand that back to you, Bobby.
All right. So now we're going to look at the prospective changes that are coming up with states have already set a date to begin the enforcement procedures. Obviously, November 1st is the next date that's coming up. So we have North Carolina and South Dakota, which again is the one that triggered the whole thing. So we have those 2 states. And then December the 1st, we do have 2 additional states, Colorado and Connecticut. The one that could be an issue for some people is Colorado. According to their state website, they do start enforcement on December the 1st. And for the local jurisdictions, they are referring people to contact the local jurisdictions in order to become registered there. So that kind of does go against what the decision was. So I could see some people kind of balking at doing that. So, but that is what the state is referring people to do. So when you get to Colorado and evaluate that one, just make sure you look at that and know that there's probably going to be some people that or some companies that kind of balk at doing that for the locals because that's kind of outside of what the decision was geared towards. So just be careful when you look at that. Georgia did issue some, as Justin has mentioned, a lot of these things change on a weekly basis, if not daily. Georgia has already issued some more guidance this week. So that would be another state that you could look at to see, what the guidance is. Even though it is effective January 1st, they kind of gave a little bit of guidance on what they're doing on that one. Iowa, Louisiana, Nebraska, and Utah are the other ones that go into effect January 1st. And there, are a few other states that are considering, when they're going to go live with theirs. The big 3 are California, or 3 of the bigger ones are California, Texas, and Florida. And then New York as well. So they'll all be looking at stuff. I'm pretty sure, there's already been some things proposed and that's going out, and they're kind of going back and forth on that. And then when the legislature starts opening back up here next year, they'll be looking at that a little more closely. The one state that's not on here is Nevada. Now they did, the governor did sign some legislation on September 27th. It did say October 1st is the effective date, but I haven't seen anything saying that they're going to go live October 1st. So that one's another one to be watching out for to see what changes they have. So you can be looking at those states to see, what's next for those states that I've mentioned that, have some changes coming up throughout the next several months. And the other thing I didn't mention was, I kind of mentioned a couple of states like Washington and Rhode Island that have some reporting requirements, and Oklahoma and Pennsylvania also have some requirements, and there's reporting requirements. So if you don't meet the thresholds, you still may be technically required to file under those statutes instead. So just make sure you're aware of those and look into those states as well. I think we have
Bobby,
here. Go ahead.
Yep, and before we go to the map, looking at some of the states you've mentioned so far, Alabama is following the simplified filing procedures by having the flat % rate for the remote sellers. Colorado, as you indicated, has some variance at the local level, which is causing heartburn. What about Louisiana? How are they treating that with their January 1st date?
Yeah, Louisiana, I think they are going with a centralized thing, and they don't mention anything about having to go to parishes and doing anything with those at this point. Now, that doesn't mean that the parishes won't come in and try to start requiring that. I know some Alabama cities were looking at doing that until the state said they weren't going to do that. So, you know, Louisiana, I think, is going to be okay as well.
Terrific.
We still do have several states that are in litigation with the collection, and the top 2 states are states with a stay saying that they can't be enforced until the court decision is rendered, and that's Tennessee and Wyoming. I don't have any update on when the dates of, so I don't think it's going to be the month of October. It could be, you know, end of this year or beginning of next year before they get a decision on those. But once they do, they will obviously go into effect either immediately, or they may have a 30 or 90 day, you know, some kind of date that they say they're going to delay the effective date of that. The states that do not have a stay are Massachusetts and Ohio. So, you know, it's you know, debatable whether, you know, they may go back and say, okay, since we had this litigation going on, that we're going to give people a pass on things, and we're going to start with the, you know, new date, or they could say they are going to go back however far they want to. So those are the 2 states that. So you're safe with Tennessee and Wyoming for now. Massachusetts and Ohio, you'll probably need to evaluate some more to see what you should do there as you do your threshold analysis.
Oh. Apologies, I don't know how it jumped onto the end there. There you go, Bobby. Sorry about that.
Not a problem. So this basically just highlights, gives you a little map to look at. So if you want to hang it up, it's you know, probably going to be outdated here next week, but at least you have something to start with, and you can kind of shade it in yourself if you need to of other states with dates. So again, it just covers what we've already discussed. So just kind of gives a nice visual presentation of where you need to be concerned about. And then the last table here is the thresholds. Some of the states are volume of sales or transactions, and there's a couple that are and. So we didn't go into too much detail here, just kind of give you the threshold to look at. Some of them are, most of them are or. There are 1 or 2 that are and then there's some that don't have a transactions application, such as Alabama, Mississippi, and Tennessee, and some are higher. You know, 500,000 for Tennessee is the highest one. So, but most of them are 100,000. And again, this doesn't cover the reporting requirement ones. This is just in order to be have an economic presence requirement that you have to evaluate. And over to you.
Yep, thank you, Bobby. Yep, and that takes us through the state updates. And Jason, it's an appropriate time for the 3rd polling question, if you don't mind.
Not at all. Let me go ahead and get polling question number 3 queued up, and that should be available on everybody's screen right now. Again, this is poll question number 3. There will be 1 more polling question after this one for 4 total polls. All right, we've got about 90% of you voting in, so we're going to leave this open for about another 10 seconds or so. All right, just above 90% now. So I'm going to go ahead and close this down in 5, 4, 3, 2, and 1. And slides are back up. So guys, back to you. Oh, and yep, there we go. Slides are back up.
Yep, thanks, Jason. So far, we've had Bobby talk through what the state ruling was, just providing a background of Wayfair versus South Dakota. He then walked through the state determination and where each of them are at currently. As a next step, we wanted to talk through tax and technology considerations you as an organization should make based on everything that Bobby has talked through. The approach that we took here is summarize some of the questions or questions that we're receiving frequently from our current client base and some other organizations in the market. First, do you need to register everywhere or conservatively register? It's really a business decision. We've seen organizations go both ways. Some companies have elected to register everywhere and be done with it, Other organizations, and I would suggest the majority of organizations, are conservatively registering. So in those jurisdictions that they know they'd be over the threshold, or they know the transactional counts are high, they are registering. Other states and jurisdictions are setting up monitoring activity just to ensure they're aware of where they are in the register or in the threshold process. Secondarily, when do you need to analyze if you've hit the thresholds? Our recommendation is first to look back reactively or retroactively to 2017. That should give a pretty good indication based on your business of how many transactions you had in these jurisdictions, as well as the transactional gross amount over the last calendar year. Another method would be to look at the previous 12 months rolling to see where it is and see if you do or will hit those thresholds that are coming out. As Bobby had suggested, some of them are just October 1st through end of year, so you may not hit over that 3-month period, but certainly be cognizant of the registration process going into 2019. That's for the reactive look. Going proactively into the future, our suggestion is to look annually. So to look annually, you'd want to determine what your thresholds are for each year and if they were not met in the prior year. If they were met, you're already registered. You don't need to necessarily watch those threshold counts going forward. If they have not been met, you will want to monitor it on a monthly, rolling quarter, or annual basis. Leads to the next question: how do you actually analyze if your thresholds have been hit or not? Our thought is that initially you'd want to create some kind of data extracts. If you are utilizing a tax engine, you should have all of your tax engines over in your audit file, providing you the ability to run a report by state jurisdiction and determine the number of transactions that have occurred and the gross amount of those transactions over a time period. Again, our suggestion would be over the previous 12 months or the 2017 calendar year to give you a good frame of reference. Assuming you're not using a tax engine, your next best option would be from the ERP or source system, which should house all of your transactional database. In the event you are using a data warehouse, that would be your third option to pull transactional information and evaluate those thresholds. Again, that's for your initial review. Then on a monthly or annual basis, our recommendation would be to create standard report outputs by jurisdiction. That gives you the ability to review the accumulated gross amount as well as the accumulated transactional amount for a calendar year. Taking us to the next question, do I need to include all sales or only taxable sales? On the states that Bobby had shown thus far, everyone is analyzing based on gross amount to determine the thresholds. That can vary by states. We've heard some noise of states saying, you know, it really should be taxable sales that we're looking at, not gross amount. To date, though, that all has been by gross amount.
And Justin, there are a couple that, since we last did this, there are a couple that are going with taxable sales only. So as I said, everything's very fluid on this. So what's right today may be wrong next week. So yeah, they're going that route. So.
Thank you for that comment, Bobby. And Bobby and I did this presentation in Tennessee a few weeks ago, and I believe there's been 10 or so states that have changed over that 2 or 3 week period. So it's very fluid. Certainly why you need to keep up with these. So the next question would be about managing the thresholds that are in place. Once you've met the threshold, when do you need to register and remit the tax? Governing authorities are saying within a reasonable time frame. What is reasonable is up for interpretation. Our recommendation is to try and do so within 30 days. Worst case, 90 days would certainly be when you'd want to go through the registration process and begin your remittance. Next question, when do I begin collecting? Oh, Bobby, did you have something to add there?
Yeah, I was just going to say that the one thing that, most of the states that I've talked to, they do say that they're going to be more lenient right now than they would be normally. So if you meet the threshold 2 years down the road from now, they're probably not going to be as lenient on people, 2 years down the road as they are now, but they know everyone, this is new to everyone. So they're probably going to be, willing to work with people more often currently than they are in the future 2 years down the road. So there are some states that give very specific procedures about how you have to file the next month, the first of the month after the, you have to register the first of the month after you've met the threshold. There's some that say you have to do it 30 days out. So some of them are getting a little specific as they propose these new regulations, but they will be a little bit more generous with leniency on people. But we do see that going forward, that once they get all this established and everything is taken care of and all the states have made their decisions, that if you wait a couple of years to do this, they won't be as friendly about things.
Yeah, that's an excellent point, Bobby. And we had someone ask us recently how the states are handling the increase of returns that they're receiving. That's a very interesting question. We've been very focused on the impact this has on the organization. Naturally, it has an impact on the governing authority and the number of transactions they're churning through on a monthly basis.
Exactly. They, we've had some that are saying that they're starting to get some in, and it's more than they were expecting. Some say it's less than they were expecting, but they're preparing for it to be especially since October 1st just started. So, probably end of next month, after everyone's, it's required to file for the first time. For all these states that just had their October 1st date, there's going to be a lot more feedback on, hey, this is, going about expected or less or more than we expected. So we'll get some feedback probably around, right after Thanksgiving time frame is when we'll know more about how, because there's 11 states or so that are having that in addition to the ones that were before it. So we'll be able to get a good read on things right after the Thanksgiving and into the holiday season.
Yeah, exactly. Taking us to our next question. Once you've gone through the registration process, when do you need to begin collecting or remitting tax, collecting from your customers, remitting to the governing authorities? As soon as you have your registration number and you're set up with the governing authorities, you'd want to begin collecting taxes from your customers. Once you collect, it's extremely important that you remit. Although they have some leniency on the registration process, there still is not leniency on collecting and not remitting. So it's extremely important that the right protocol and processes are set up to collect and remit at the time of registration. Taking us to the third question, what tax do I register to collect and remit? Wayfair, South Dakota was an impact on the remote seller. Your registration would traditionally be the seller's use tax. As Bobby had indicated, though, the physical presence law is still in place, so that still would take precedence. If you have physical presence, you'd file the sales tax, else you would file the remote seller's use tax. That takes us down to more of a system question. How do I start the collecting and remittance process from the customers? Again, a good majority of states are looking at this and saying it's based on gross amount. And if your sales are traditionally exempt, you may not have a tax engine today, which leads to the question, if you don't have a tax engine, how do you go about doing this? Your two options are either A, consider implementing a tax engine, or you'd be required to manually insert rates and rolls into your customer master or into your source ERP system. Given the fact that Wayfair is going to increase the filings for a good majority of organizations, the ability to maintain the number of rates and rolls and the changes in rates and rolls may not actually be possible, which would lend to implementing the tax engine, taking care of the rate maintenance for you. If you already have a tax engine, all you have to do is enable Nexus and insert your registration information. So it's simply a 5-minute process. You then would be collecting and remitting taxes. So what other considerations do you have to make prior to enabling tax for calculation? And I think this is important and something that can easily be overlooked. First of all, if you do have exempt sales and you're going into a new jurisdiction because of Wayfair, you do need to obtain all of the exemption certificates from your customers. Historically, you didn't have Nexus there, so you may not have requested certificates from that customer base. Now, going into that state, it's important you have them on hand, on file, and if you have a tax engine, you have those certificates loaded into your tax engine. Otherwise, you'll enable Nexus, you'll charge every one of those customers tax, and you're going to have a customer service challenge on your hands. Secondarily, there would be a taxability study for the products and services that you're offering in the newly registered jurisdiction. Traditionally, TPP is taxable, services are exempt. That naturally varies in quite a few different states. So looking at that, you'd want to make sure you understood the taxable and exempt treatment. If you're using the tax engine, you'd want to make sure your mappings to the tax engine content are correct prior to enabling that new Nexus obligation. Finally here, do I have to worry about the home rule states? Interestingly enough, we have in here currently not applicable. As Bobby had talked through, the reason we had it worded this way is Alabama maintained the simplified filing by offering an 8% rate across the board. Colorado threw a little bit of a wrench into that with the way they treated it. Louisiana seems to be following the simplified, but it's absolutely something you'll need to monitor. Our thought going into it was they would all follow the simplified filing method. That's how I understood it. Colorado naturally has gone a little bit rogue on that. Before going into registering and calculating, Jason, can you please release the fourth polling question?
All right, fourth polling question should be up on everybody's screen, and that should be live right now. Again, we're going to leave this open long enough for everyone to get credit, and you've all voted in very, very quickly, but I should let everyone know that this is the final opportunity to answer a polling question for CPE credit. There will be no more polling questions after this poll concludes, and this poll will conclude in about 30 seconds or so.
And I did have, I saw a couple of the questions, so I figured I'd answer at least one or two of those while we were doing the polling question. Someone asked about Hawaii. How am I supposed to go back and collect? That's going to be a very huge problem for people. You can send a bill to someone, but it doesn't make, you don't have a lot of hope that they're going to pay that. So in theory, if they doing that, not collecting from day one, you will have to pay that yourself and not be able to collect that back. So that is a problem, which is why a lot of the taxpayer advocates are stating that they should change that to where it's only proactive instead of going back to when you the first 100,000. And then the other question that was pretty easy to answer was online. Does this apply to online sellers only? No, this applies to people who do catalog sales and other type of sales as well. It's not just internet transactions. So just to answer a couple of those questions, there's a couple more that we can probably answer at the end as well.
All right, I wanted to save a couple of questions till we got to the end of the webinar, but as of right now, we have about 95% of our audience reporting in, so I'm going to go ahead and close this polling question down. And the slides are back up, so Bob and Justin, back to you guys.
Yeah, thanks, Jason. So that takes us through to the registration, or I'm sorry, the registered and calculating. And what we're looking at here is you've hit your thresholds, you've received your registration number from the governing authorities. So here's some additional considerations you'll want to make. First of all, you're ready to calculate now. You have your tax engine enabled, you have your registration number, but how are you actually going to display that tax on the customer invoice? The taxation will come back from a tax engine by jurisdictional level. So you'll be able to see the state, city, county, and district taxes. It's then based on the printing procedures within the ERP system on how you'll display that. Additionally, do you want to show it as bundled or separately stated? I believe that depends a little bit on the nature of your business and the products or services that you're offering. And finally, freight considerations. There's a lot of different ways to configure for freight obligation. It's one of the more complex scenarios on the sales side, meaning do you view freight based on weight? Do you evenly allocate it to the various lines? If the product is exempt, would you also treat the freight as exempt? Those are the types of considerations you'll want to make during the taxability study that we'd encourage you to do prior to enabling Nexus. Once you've collected tax from the customers, what do you need to do next? As part of the registration process, you'll know your filing frequency. That'll be determined by the governing authorities. Based on that filing frequency, you'd either enable internal returns application or you'd notify your compliance provider prior to the month-end activity. So if you look at it, you'll be calculating tax from October 1st, let's call it, through October 30th. The return would likely be due November 20th. Ensure you give your compliance provider enough time up front so that they can configure the system accordingly for you. Taking us to our next question, once you start collecting, can you stop at any point in time? The short answer is no. Once you've registered, generally most filings remain for that entire year and the following year. You'd then have to reevaluate your thresholds and essentially make a business case for the governing authorities that you no longer have the filing obligation given changes in your business. States may start allowing inactivation of registrations for years that were not met. It's kind of a gray area or an undetermined area for the most part right now. Finally, what can I do to avoid all this? Almost rhetorical question, but the only way you can avoid this is to stop sales in that state prior to meeting the thresholds annually. Haven't met a lot of CEOs or CFOs that find that to be feasible. So what we're getting at here is this essentially is applicable to anyone conducting business in these jurisdictions. It's critical that you are able to track your thresholds, that you're registering, and going through the compliance due diligence. Going on to some additional considerations, should you register through the Streamlined Sales Tax website, there are advantages to the SST website. It provides one filing location for you. It should streamline the process a little bit. However, you are registering in all 23 states at that point in time and remitting tax. It's not only limited to the states that you've met the threshold. So I think there's advantages to it. The downfall is certainly registering in all 23. It does have limits on the volunteer filer as well. Another question we've been asked several times is, what will the tax engine providers do to modify their solution for this? And I've spoken to many folks at the tax engine providers such as Avalara, and short answer is there's really nothing that they have to do. If you think about it, once you're registered, it's just a matter of enabling Nexus, which, as I'd mentioned, is a quick process. You then insert your registration information, the returns are the same. From a tax engine standpoint, it's the same process and protocol as always. It's really the due diligence that happens before the calculation that's changed, and that is the threshold management. That's the business processes you'll need to put in place around those items, and the continual reporting requirements in states such as Colorado. One of your other options is to look into some amnesty programs or VDA opportunities prior to registering in any states. Bobby, I don't know if you have any news on any new or upcoming VDA amnesty opportunities.
I did not list those out, but if anyone wants to have questions afterwards, we can send them the list. There are a few states that do have amnesty or VDA programs right now. So if anyone wants to ask us, we can provide that information to them.
Okay, perfect. Thanks, Bobby. Last comment on here. What other concerns should you be aware of? And these are just some pointers, if you will. If you're in the business of service software or software as a service, it's generally taxable in several states. There's other states that do not consider that to be taxable. As you're entering new jurisdictions, certainly consider the taxability of software as a service. That's a changing tax area, so it's something to certainly keep an eye on. The other thing is consumers' use tax requirements. The thought here is as more and more more organizations are registering in additional states, you won't have the obligation for as many use tax accruals as you did historically. Now, keep in mind, though, many of these organizations charging you tax are now registering. They're new to the sales tax in that particular jurisdiction. You'll want to keep an eye on the tax that they're charging you. Is it the appropriate rate? Is the product or service that you're purchasing from them actually taxable? So you may want to set up some policies and procedures around reviewing vendor charge tax more scrutinized than you did historically. The third bullet there goes hand in hand with Colorado. Local jurisdictions could attempt to establish economic nexus thresholds and require collection if thresholds are met within their boundaries. I personally didn't anticipate this. I thought it was kind of counterintuitive to the entire Wayfair versus South Dakota ruling. The goal in my mind was to make it simple so more organizations are registering and remitting tax, and the states are collecting more of that $8 billion to $33 billion they've left on the table historically. Local jurisdictions still do have the right, though, to put some of that regulation in place. I mentioned this earlier. Most critical item in my mind is to make sure there's never a situation where you're collecting tax and not remitting to the jurisdictions. You'll want to at least pay those taxes annually. It's a very serious ramification for collecting and not remitting. Final comment there is just to look at the ASC 450 financial statement requirements if substantial changes in non-income tax contingencies. We have seen some changes there. I personally haven't followed the ASC 450 very closely. Bobby, I don't know if you have any other comments on that particular one.
Yeah, just put it in there because there was a couple of companies that have made some financial statements. They've done that, and so just wanted to put that out there in case someone had seen that. But again, like Justin said, it shouldn't have much impact there, but that's something that you need to look at your financial statements and see if work with your tax professional on that to see what you need to do on that piece of it. But just be mindful of that as well.
Mm-hmm. And Bobby, did you want to talk about the last couple of additional considerations here?
Yeah, the other thing is, if you're an internet provider or internet seller, just some things to be looking out for. There are some and other things as well. They have the cookie nexus states. Basically, just if you leave cookies on a website, and these states are making you start tracking, remitting, collecting, that sort of thing. And then the Marketplace Nexus states is another thing. This one, these are the states that are on the list. So if you're an Amazon or an eBay or something along those lines, then they're wanting people to, if you offer a marketplace to someone, whoever hosts that, they're wanting those people to actually collect and remit on the people's behalf that they sell for. So if you do that sort of activity, you want to make sure you're looking at these states and evaluating those to see if you've met their thresholds in order to do that, in addition to if you just sell stuff directly.
Yep, thank you, Bobby. And that concludes all the materials we had. Within the appendix, you'll find the contact information for both Bobby and I. Any questions that you have or comments, certainly feel free to reach out to both Bobby and I directly. We also have some resources here within. As I'd mentioned, let me scroll down to that real quick. Oh, thought we had the resources in here. We'll make sure that gets added in for different websites that'll help with the tracking. So we'll add that in as well. But that's everything that we had. Again, really appreciate everyone's time. Thank you for joining us this afternoon.
We had a couple of audience questions come in. We might be able to field a couple right now before we wrap up today in about 5 or 6 minutes. Let me see if I can pull out a good one. Michael asks, what is the reporting filing frequency? Does it vary by state?
Yes, it does vary by states. There are some states that do list the thresholds. If you're, 100,000, they list a threshold of when you're going to file, and 100,000, 500,000, whatever the ranges are. There are some that say you'll be quarterly, monthly, annually, and then there's some that they just say you file monthly to start with. We'll see how it goes, and then we'll tell you if we want you to do it differently. So some are wide open to say we don't know for sure. Others are very specific on what they want to do with the different thresholds. So in short, the answer is it does vary quite a bit.
All right, Caitlin wants to know, what do you recommend for very small sellers like Etsy shops?
I can comment on that. Looking at an organization that is an Etsy shop, that's really why they did have the thresholds in there, to try and avoid killing small business, if you will, with these filing requirements. My recommendation would certainly be to look at a tax engine. And the reason I say that, use Avatax as an example. It's transaction-based in terms of the subscription. So it would give you the ability to maintain all the rates and roles for you. You would do your registration. It's quite intuitive. So I do believe a tax engine would help substantially with that. There's also a managed service component that could help. So the setup here with Wayfair versus South Dakota was supposed to make it so it doesn't kill small business. Organizations like Avalara are certainly there with technology to try and help circumvent that even further.
All right, this should be the last question that we have time for before we wrap up. Crystal asks, if we have to register for sales tax, do we also have to register with the Secretary of State in that particular state?
Most often you do. I would say, if not all the time. Basically, there's different requirements for that in income tax purposes as well, but you may have already been, if you're filing income taxes and other taxes, you may have a requirement to do that anyway. So most likely you'll have to, and sometimes it requires that you file that before they'll even issue you a sales tax license. So when you start going down that road in the states that you're not registered with the Secretary of State, then they will tell you before you're able to do this sales tax registration, you will be required to go and do the Secretary of State filing first.
All right, and with that, we're just about out of time. So Bobby, Justin, do you have any concluding thoughts before we wrap up?
No, Jason, I think it's just like we said, it's important to make sure you're monitoring the status of each of the states as they're changing so regular. It's important to have a method in place to monitor the thresholds and go through the compliance due diligence. It's the only component I'd add to it.
All right, Bobby?
Just reiterate what Justin said. Just make sure you're analyzing those thresholds, keeping up to date, and trying to stay ahead of the game of when the deadlines are, when they have the collection start dates, to make sure that you're looking at those ahead of time and make sure you're following either signing up for something or monitoring it yourself, but just make sure that you're keeping up with things, because they will be changing probably for the next 6 months at least.
All right, well, we are just about out of time, and before I go any further, I just want to thank you both for spending part of your day with us here at CPA Academy and bringing your knowledge to our attendees over here. So thank you both so much for your time today. And of course,
Yeah, thanks, Jason. Appreciate it.
Yes, of course. And of course, thank you to Avalara for sponsoring today's session. Thanks to Avalara for sponsoring so many other great sessions here on CPA Academy. I saw somebody comment in the questions panel, how will we get credit? We will be processing your credit by the end of the day today, and the credit will be available in your CPA Academy account along with an archived recording of this session and a copy of the handouts. Thank you all so much for your time. Bobby, Justin, thank you again for presenting. Thanks to everybody at Avalara for sponsoring today's session. We hope you all have a great rest of your day, and we hope to see you all on future webinars.
Thank you.